Welcome back to another episode of Uncontested Investing. So happy you're joining us today. I'm your host, Nate Selinsky, joined by my co-host, Suzanne Andreessen. Suzanne, again, we have another episode that can be really impactful for investors. We're going to do a deep dive on economic indicators that every investor should track. I really think the goal of this episode is going to be to equip investors with key indicators to monitor for smarter investments. That's really the goal here. There's some telltale signs based on the U.S. economy, some different indicators we're going to jump into that can really tell you where you should be going and what you should be doing as it pertains to investing in real estate. Let's get started with
gross domestic product, also known as the GDP. It's essentially the total value of goods and services produced, and that is a key indicator of the health of the economy.
Yeah, sure. I think GDP is the low-hanging fruit. It's something that the acronym that everyone has heard. The impact on real estate can be rising GDP often correlates with increased demand in property values. So, a good, healthy GDP is what you want to see. Some of these indicators, more of it is not such a good thing. I think when the GDP is a little bit higher, that means the U.S. economy is kind of firing on all cylinders. Now, with increased demand and increased property value, to bring it back to real estate investing, that is going to enhance competition, right? More people are going to feel like they have the money to go after these investment properties.
Yeah.
Exactly. More families are going after their primary home. So although a good GDP may be good for an investor, there also are some things to think about in terms of, okay, I might have more competition than I normally would for this property. So I've got to be a little bit more aggressive, make sure I have access to that capital, and I can go after this property with full confidence.
Well, and that's yes and no. You want to make sure you can go after it with full confidence, but if the market shifts, can you stay on the higher price point? Yes. So, don't jump in with 2 feet without really understanding your financial picture. Yes, the health of the economy certainly speculates where that you think it's going, but we've seen that change overnight, and you don't want to overextend yourself at the same time.
The next important economic indicator is unemployment rate. So this obviously is going to reflect the strength of the labor market, and how it can affect real estate is, the lower the unemployment is, it boosts purchasing power. More people have jobs, more people have that income, more people are looking to secure that property rather than maybe just typically looking to rent. The rent rates are a little bit lower, but high unemployment can signal economic slowdown. So it's kind of a slippery slope. There's a number where, the U.S. economy is okay with the unemployment rate, but if it dips a little bit too high or too low from that, that's when an investor should really be paying attention.
And you need to make sure, and this goes into, if you put a tenant in there at a particular rate and then they're unemployed, what's going to happen there? Can they quickly get a new job, or all of a sudden are you at risk of losing rent and then perhaps getting into having to remove that person?
Yeah,
there's some pieces you got to pay attention to.
I would say that lends itself perfectly to tenant vetting for real estate investors, right? If the unemployment rate is a little bit higher than normal, you're really going to want to make sure, okay, what kind of job, what kind of industry does this potential tenant work in? What is their job security look like? How long they've been there is a great telltale sign, great indicator of whether or not they may be able to hang on to that job. So all these things are going to impact real estate in a different way. And I think the unemployment rate is a perfect one right there for investors to keep an eye on, because if you're out of a tenant, then you're out of some rental income, the portfolio starts to suffer a little bit.
Sure. And can you weather it? Can you weather it until the next uptick happens, or do you really have to correct it in the moment?
I would say the next topic is probably one of the most searched things on Google in the past 12 to 18 months. You guessed it. We're talking about interest rates in the Federal Reserve. So the role of central banks to begin with is adjusting rates that influences borrowing costs. And everybody has had questions. When will the rates go down? When is the next Fed announcement? The impact on real estate is immeasurable when you're talking about interest rates in the Federal Reserve.
But having, those slight fluctuations have an immediate impact on housing. And it's, if they drop, you watch, there's an instant of applications on mortgage.
Yes.
And then you have the same response for acquiring an asset and then getting tenants in there. So it's an interesting dichotomy that I think you have to is it there? Is it there to stay, or is it temporary?
Yeah.
And that's really the question that, if you knew the answer to that, you wouldn't even need Powerball.
Yep. That's one of those things where it's important to read beyond the headline, right? So if you see that drop in lower interest rates, that typically means that it's going to stimulate property purchases and refinancing. Essentially, financing becomes more accessible when interest rates drop. But as you mentioned, is that just short term? Is that long term? Is that trend going to continue? Are we going to start seeing dips and peaks with the interest rates? So really getting the full picture and not just seeing, okay, oh, the Fed just dropped the interest rates, it's time to go and scoop up properties. You really have to take a look from a 6-month perspective, a year-long perspective, even 18 to 24 months into the future of what those interest rates look like, because it can change in a hurry, and that can be a good thing or a very bad thing.
Well, and trending, you need, it's sometimes you automatically jump in with both feet. And had you waited another 30 days, perhaps another quarter or half a point would have been in your favor.
Mm-hmm.
So those are some of the things that you need to, as much as you're dying to acquire the asset, I think sometimes really making sure it has stabilized or isn't going to dip further, where you could have, made a little bit more money on that transaction.
Yep. And in this climate today, with interest rates a little bit higher than normal, most people would say, there's still a lot of investors that are extremely active within this market. So just because the interest rate is a little bit higher doesn't mean that you shouldn't be investing, because when the interest rates go lower, that enhances buying power for everybody. And it goes back to that conversation about competition. Once you hear that interest rates go lower, everyone is on Zillow. Everyone's looking for properties. So your buying power may increase, but so does your competition. Whereas when the interest rate's a little bit higher, that less competition, you can see a lot more properties enter your portfolio in a market like that. And then once you have them and the market takes that downturn or the interest rate decreases a little bit, that's when you start talking about refinancing rather than trying to acquire new properties, because it becomes a much tougher environment when the interest rates are lower.
But also the upside of acquiring, it's not that we're not tied to the financial markets, but I think the investors have the opportunity to pivot to the market's needs. And we still have a significant housing shortage. And while the interest rates are higher, and they have been up and buoyed for quite some time, I think that bodes well for rental. And so I think if you have to play both sides of that equation. And I think having a little bit higher interest rate, even if you bought a little high as the investor, you still have several people that are going to want it. If it's, a decent house in a good neighborhood, you won't have a problem getting a tenant in there. And they'll probably a lot of these folks want to do it over longevity too. I've seen a huge shift in longer term tenancy.
Yes.
And I think that, that's here to stay for a while.
Yeah. The surplus of renters that a little bit higher of an interest rate provides should be, a green flag for anybody investing in real estate, right? Okay, maybe I'm taking this property on at a little bit higher than I'd like, but the world is my oyster in terms of people that are now looking to rent instead of buy. So it really sets you up in a nice position financially, because you have that rental income, that steady flow should soon follow if you're able to secure that property.
Well, and then you could look at a portfolio loan down the road. If the rates really, I'll say correct, if you want to call it that, you have the opportunity to take all of your assets and put it into a portfolio note and find a way to that really manage that strategy.
Mm-hmm. I think just behind interest rates is inflation, the rate at which prices for goods and services rise. So I know the U.S. economy has been dealing with inflation as well for the past 12 to 18 months. It's kind of gone hand in hand with interest rates. And this can lead to so much higher costs. You're talking about construction. It reduces purchasing power and influences mortgage rates as well. So inflation and interest rates are kind of the evil step twins of each other. And, if one rises and the other does as well, it can spell, doom and gloom for the overall U.S. economy.
But not for the investor.
Exactly. You are right. That's an important.
I don't mean it as a mockery, but that creates a stronger need for rental.
Yep.
And we've seen that over the past 5 years, where the fix and flip used to be a 65-35 split to buy and hold, and it's got a completely 180 on that. I think we only see 35% really on the fix and flip, and those are the properties that are going back on the MLS, and the rest of these are being held in portfolios for rental.
Yep. And I know it's an important conversation to have. The real estate investor really it's a hard thing to do, but really they need to separate themselves from the mainstream media, the overall US citizen, right? The investor has to have just a touch of a different mindset where tougher economic conditions for the average person may mean having a field day for you as a real estate investor. So that is an extremely important distinction to note. And real estate is one of the best hedges against inflation because if everything goes up, that means the price of real estate goes up, means your property appreciates in value at a much quicker rate. So in times of inflation, you're deciding what to do with that property. It's been in your portfolio for maybe 15, 20 years, and you see a spike in inflation. Maybe it's time to offload that property. Maybe you might never be able to see a higher return on investment unless you sell that property right then and there during that inflation period. So that's something that's food for thought for investors as well.
And that comes back to our conversation that we're going to be having in a future date about tax savings.
Yes.
Understanding how to offload these properties and how did you set that up and what was your duration for disposition and how have you been depreciating over time. So these are some of the things that you want to understand on the forefront prior to acquiring the asset is really, as you talk about inflation and things, where do you want to see your portfolio 5, 10, 15, 20 years down the road? And how do you want to manage it holistically, including,
Yes.
your tax obligations?
And it's important to note too, it doesn't have to be your entire portfolio, but I think it's worth taking a look at and picking and choosing, okay, is this the right strategy for this property or this property? So you can be flexible, more flexible than you think when the higher inflation rates start to spike. The next economic indicator we want to talk about is, I think, another extremely important one, can sometimes be underrated and overlooked, but housing starts and building permits is a huge indicator for what the real estate market is doing at any given time.
Well, and if you look at, we have a whole vertical in the investment space called the B2R,
Mm-hmm.
build to rent, and I think that's where you're seeing, a huge jump in housing starts.
Yes.
And there's a lot that's to be said for that, where you can take your local, and I encourage any of the smaller investors, if you have the opportunity to build from the ground up. There's a lot of things you can do with that. The life of the asset, everything's new at that time frame, but you also have the ability to build to your buy box. You know what
Yes.
that neighborhood's going to produce, and so there's things that you can do to support from the ground up a very good strategy for you.
We've talked in recent episodes about the lack of inventory and the stress that puts on investors. So that's why you're starting people take it upon themselves to create their own inventory. And that's where you see those housing starts, those building permits. That's when they really flow in. When investors have nowhere else to turn, they can create, customize to their buy box, and really set themselves up for success.
And certain states, I'm from the state of Maine, and they have the state government has said to every parcel in the state of Maine, they have now been, it's called LD 2003. They've now been granted the permission to build an accessory dwelling, regardless of whether you're in a particular zoning. So I live in a 3-acre zoning for one house. I can actually add on an accessory dwelling so long as I meet the setback. I can have a second unit. So now you start looking at how has zoning transitioned at the same time frame in the housing starts, and you can do in some cases a 2-for-1 engagement from that as well. So there's a lot of, understand your environment, understand what goes into how you can really, I don't want to say manipulate your portfolio, that's the wrong word, but manage and explore opportunities.
Get the most out of it.
Yep.
So housing starts and building permits are also going to be able to reveal developer confidence and future inventory levels. But it can be a slippery slope, right? Because just because a property gets built doesn't necessarily mean that it's going to get filled with a tenant in a timely manner. So investors do have to be careful of that. That's something to consider for the long term. And rising starts may indicate oversupply. The market gets oversaturated. You build all these homes, but nobody's living in them. And a decline in housing may indicate a tight market where people are really staying where they are. They're staying pat. They don't want to make a major life change because the market kind of dictates that they need to be able to stay where they are, afford the rent that they're currently paying or the mortgage that they're currently on. And that's when you'll see a decline in housing starts or building permits.
Well, and we're right there right now where you're seeing the housing starts where people, have mortgage rates at 3.5%. You're going to get half the house for what you had from before. So they can't move forward, so that's where it even comes in to even bigger position of being in the landlord. Because if they can't move or buy a new place, they can't buy a new place because of what their current mortgage rate is, but maybe they need a bigger place, family's expansion or something like that. you can step in and save that.
Yep. The next economic indicator is going to be the Consumer Confidence Index, and this measures how optimistic consumers feel about the economy. What this can do to the real estate industry includes higher confidence that can lead to increased home buying and investing, right? So, pretty self explanatory, but if the average American consumer is fairly confident about the state of the economy, they're going to be making their money a little bit more active, right? They're going to be looking for that next investment property, looking for the new house, looking to invest in the stock market. So overall, a higher consumer confidence index means much more activity within the industry itself.
Well, and RCN Capital is known for their investor sentiment survey, which has been featured in the Wall Street Journal, and it gauges the confidence and the temperature of the industry's peers. So it's a great strategy to really understand, and you're providing a lot of very good data for that.
Yeah, I think it's a great balance, right? So the consumer confidence index is kind of the US economy as a whole, but then you can take it another layer further and really learn from industry peers. How are they feeling about the market? Is the overall outlook positive, negative? Where is that going to be in the next 6 to 12 months? So, all these tools at your disposal, all these economic indicators, investors really should be tuned into it. So, RCN Capital took it upon themselves to take it one step further. And why not gauge the temperature of that market? You can learn so much. Really, that's just an example of what these indicators can teach you and what you can learn from them if you're open to it.
And it really shows where the market's heading. You know, when you see from your peers on what getting the survey and really quantifying. It's not just a snippet from here or there. It's a whole survey from, and I think it's a great strategy to understand what the market's doing.
Mm-hmm. Another indicator that's really important is mortgage rates and lending standards. So tracking these types of changes can really help you dictate the overall health of the economy. Mortgage rates and lending criteria, if this is changing every so often, that's typically a good thing. If it's changing, month over month, that means that, the mortgage rates may be rising, dipping, whatever the case may be. If the guidelines from lenders are always changing, that means that they're trying to stay accessible. They're trying to stay ahead of the curve so people can still use that lending outlet when they're looking for their next real estate investment property.
And affordability is that's really the word for the whole side of the equation, whether it's buying or renting. It needs to be affordable. Yep. And that's what people are trying to gauge is where do we sit in the affordability, and how are these influxes of interest rates really changing, and how can people want stability, and that really is a place to live first.
And I think when mortgage rates are changing, and an investor really needs to take it upon themselves to reach out to a lender that they know and trust, reach out to a lender that they used before and ask simply, what does this mean for me? What does this mean for the guidelines? What are you guys planning on changing? Is there any advice you can give me? Any lender that's credible will be able to step in and kind of give you that insight about where the market's headed. So as an investor, it's always important to stay ahead of the curve, not just react to some of this data, but be proactive and really realize that if I have the knowledge, I can actually be ahead of the curve and hedge against where the market's headed.
It's true. And being able to respond quickly. And even if you sat and spoke to, we talked earlier about your mortgage broker, if you had that relationship where they said, hey mate, here's what this means to your borrowing power, that's really the relationship that you want to count on and being able to manage that.
Yep. Some other indicators that we want to wrap up this episode with include local economic data, but also commercial real estate indicators. For investors involved in commercial properties, you really want to be tapped into vacancy rates, rental rates, leasing activity. This really gauges how healthy that investment opportunity is, right? Just because a commercial property comes on the market doesn't mean that it's the right investment for you. There's so much more that goes into a commercial real estate investment property versus a residential, pretty small, relatively manageable, face-to-face relationship with tenants. Typically, when you have a commercial investment property, that can change in a heartbeat. So being well informed about where those investments are going and what that looks like is important for an investor to know.
Well, and look what happened to New York City during COVID and some of those high-rise commercial properties and when people left the city, those, what happened to the asset. And some of those actually turned into residential high-rise buildings. Mm-hmm. They were transformed in that. And that does two things. One, it addresses the housing need, but you have to, be able to weather a storm or find a new purpose for the asset and be able to do that on dime and pivot as necessary. And that way the vacancy rates aren't going to hit you as hard as some of the others were.
Yeah, and a lot of commercial investors started on the residential side and built their way up to being able to afford those. So if they're starting to see signs on the commercial side that it's getting a little bit unhealthier in terms of a market perspective, maybe it's time to go back and dip into the residential pool. As for residential investors, if they see, the commercial space is overall very healthy and improving, and they've been on the fence about whether or not they should transition into the commercial side, maybe when the market's the most healthy is the time for them, right? It's when the playing field is the safest. They don't have to worry about taking on too much risk because the environment and the economy is telling them that it's okay to make that jump at this time period. So being tapped into that can tell an investor where to go next.
But consider also bridging the gap with a multi-use.
Yes.
With commercial first floor and residential second and third or something such as that, because it'll give you the best of both worlds.
That's a great stepping stone to get involved in the commercial side, right? You get the best of both worlds a little bit there. You have the steady tenant and their rental income, and then you may have the aggressive turnover on the commercial side. So it can really prepare you and kind of test your sensibilities. Are you really ready to take this on if something were to go wrong, or dealing with that whole new set of parameters as it pertains to that commercial side?
And it's a smaller scope to jump in.
Yeah.
You're only going up to your knee versus your neck.
Yep. And I think with all these economic indicators, as I mentioned, you have that local economic data. So yes, the national data can tell you a lot, but certain markets, you'd be surprised how polarizingly opposite a specific market can be from the national data. So again, if you're hearing one thing in the news, be sure to check that against the local economic data of where you're investing, right? Unemployment and income levels in specific markets can be night and day. The industry growth or decline depending on the market you're investing in, and then how those local factors can diverge from the national trends, as we mentioned. That can determine if you're going to stay the course and say, okay, what I'm working on and the markets I'm working in are perfect. I just need to keep doing what I'm doing. Or that can say, okay, on the national average is a little bit healthier. The local economy that I invest in is seeing a little bit of a downturn. Maybe it's time to broaden my horizons a little bit and invest in some healthier markets. So the local data can tell you the story on a day-to-day basis that the national data just can't.
Well, we see, a lot of times in the southern states, the rentals are a little bit lower, but also the income's a little bit lower. So, what is the true cost of living in each of those markets, the cost of rent, the income, and all of that piled into there. And I think you'll find, with that, where you may want to start to invest and manage your portfolio.
Yeah. And we've talked about it during this episode, but I think it's the perfect place to leave it. Don't get bogged down as an investor with what the national news media outlets are telling you. Because for you as an investor, the playing field is completely different. You're living in a deal-to-deal scenario. You're living from market to market. So if the deal makes sense from a numbers perspective, keep going, right? Don't let the industry or the national economy tell you that you shouldn't be investing in real estate anymore, or it's getting too risky, or the interest rates are getting too high. If the deal makes sense for you, keep pushing ahead as an investor.
Sure. If you're able to make it balanced and at least break even, if not make money on it, it's still a good transaction in the difficult economy. Imagine how good it will be in a good economy.
Exactly. That's the mindset that every investor should have. We're happy to go in depth on another great topic to help you understand the economy, the industry as a whole. So thank you for joining us today on Uncontested Investing. It's been a pleasure talking about economic indicators every investor should know. And we'll see you next week on Uncontested Investing.
See you soon.
Thank you for listening to Uncontested Investing. Questions about today's episode or the podcast? Email podcast@rcncapital.com and make sure to follow REI Inc. magazine on LinkedIn and Facebook, and RCN Capital on Instagram, LinkedIn, and Facebook. See you all next time.